Today, we'll be exploring the basics of investing in the stock market, breaking down complex concepts into easy-to-understand pieces. Whether you're a complete novice or just looking to brush up on your knowledge, this guide is for you. Let's start. What are stocks? First things first, what exactly are stocks? Stocks represent ownership shares in a company. When you buy a stock, you're purchasing a small piece of that company, making you a shareholder. Companies issue stocks to raise capital for various purposes, like expanding their operations or funding new projects. Let's break this down a bit more. Imagine a company as a large pie. Each share of stock represents a slice of that pie. When you buy a share, you own a slice of the company's pie, which includes its assets and profits. Types of stocks. There are two main types of stocks, common stocks and preferred stocks. Common stocks. These are the most prevalent type of stock. Common stockholders have voting rights, which typically allow them to vote on corporate policies and elect the board of directors. However, common stocks also come with more risk. If the company goes bankrupt, common shareholders are the last to be paid, after debt holders and preferred shareholders. Preferred stocks. Preferred stockholders generally do not have voting rights. However, they receive dividends before common shareholders and have a higher claim on assets in the event of company liquidation. Preferred stocks are often considered a hybrid between bonds and common stocks due to their fixed dividend payments. Why do companies issue stocks? So why do companies issue stocks in the first place? Companies issue stocks to raise capital, which they can use to grow their business, fund new projects, pay off debt, or expand into new markets. By selling shares, they can obtain the necessary funds without having to repay loans or interest. Stock exchanges and how they work. Stock exchanges function as auction markets where securities are bought and sold. Here's a step-by-step look at how this process typically works. 1. Listing process. Companies that wish to offer their shares to the public must first go through an initial public offering, IPO. During an IPO, a company sells shares to institutional and retail investors to raise capital. Once the IPO is complete, the shares are listed on a stock exchange, making them available for public trading. 2. Trading. Investors can buy and sell shares during the exchange's trading hours. Trades are facilitated by brokers who act as intermediaries between buyers and sellers. There are two primary methods of trading, on the trading floor and electronically. Trading floor. Traditional exchanges like the NYSE have physical trading floors where traders conduct transactions in person. This involves a system of open outcry, where traders shout bids and offers and use hand signals to negotiate prices. Electronic trading. Most modern exchanges, including NASDAQ, operate electronically. Investors place buy or sell orders through an electronic trading platform. These orders are matched by an automated system that executes the trades instantly. 3. Order matching. The exchange's trading system matches buy orders with sell orders based on the prices and quantities specified. This is done through an order book, where all the pending buy and sell orders are listed. When a buy order matches a sell order, a trade is executed. 4. Settlement. After a trade is executed, the settlement process begins. This involves transferring the ownership of shares from the seller to the buyer and the corresponding payment. Settlement usually occurs within 2 business days, T+2. Before we move on, if you're finding this video helpful, please give it a thumbs up. It really helps us out and lets us know you're enjoying the content. And don't forget to hit that subscribe button and ring the notification bell so you never miss an update from us. We've got plenty more tips and insights to work. Thanks for your support. Now, let's get back. Price determination. The prices of stocks on an exchange are determined by supply and demand. Here's how it works. Supply. This represents the number of shares that sellers are willing to sell at various prices. Demand. This represents the number of shares that buyers are willing to purchase at various prices. When demand for a stock is high and supply is low, the stock price tends to rise. Conversely, when demand is low and supply is high, the stock price tends to fall. Prices fluctuate continuously during trading hours as investors react to news, economic indicators, company performance, and other factors. Regulation and transparency. Stock exchanges are heavily regulated to ensure fair trading practices, protect investors, and maintain market integrity. In the United States, the Securities and Exchange Commission, SEC, oversees the activities of stock exchanges and enforces regulations. Regulations require exchanges to maintain transparency by providing real-time price information and ensuring that trades are executed fairly. This transparency helps investors make informed decisions and fosters trust in the financial markets. Benefits of stock exchanges. Liquidity. Exchanges provide a liquid market where investors can easily buy and sell shares. This liquidity ensures that investors can convert their investments into cash quickly if needed. Price discovery. The continuous trading activity on exchanges helps determine the fair market value of stocks. This price discovery mechanism reflects the collective knowledge and expectations of all market participants. Access to capital. For companies, being listed on a stock exchange provides access to a large pool of capital from public investors, which can be used for expansion, research and development, and other business activities. Investor protection. Regulatory oversight and the presence of institutional investors help protect individual investors from fraudulent activities and market manipulation. Understanding how stock exchanges work is essential for anyone looking to invest in the stock market. By providing a transparent and regulated platform for trading, stock exchanges play a vital role in the global economy. How to buy and sell stocks. To buy or sell stocks, you'll typically use a broker. Brokers act as intermediaries between you and the stock market. There are two main types of brokers: full-service brokers and discount brokers. Full-service brokers. These brokers offer a wide range of services, including investment advice, portfolio management, and financial planning. They charge higher fees but provide personalized services. Discount brokers. These brokers offer fewer services but charge lower fees. They are ideal for investors who prefer to make their own investment decisions without the need for advisory services. Once you've chosen a broker, you'll need to open a brokerage account, deposit funds, and then you can start buying and selling stocks. It's important to understand the different types of orders you can place, such as market orders, limit orders, and stop orders. Market orders: buy or sell immediately at the best available price. Limit orders: buy or sell only at a specific price or better. Stop orders: trigger a market order once a stock reaches a certain price. Ownership and dividends. As a shareholder, you may also receive dividends, which are payments made by a company to its shareholders out of its profits. Dividends can provide a steady income stream and are typically paid quarterly. Not all companies pay dividends. Some may reinvest their profits back into the business to fuel growth. Additionally, being a shareholder means you have voting rights on important company matters, such as electing the board of directors, mergers and acquisitions, and other significant corporate policies. These votes are typically exercised during the company's annual shareholder meeting. Risks and rewards. Investing in stocks can be rewarding, but it's also important to understand the risks involved. Stocks can be volatile and their prices can fluctuate widely in short periods. The value of your investment can go up and down, and you could lose some or all of your money. However, historically, stocks have offered higher returns over the long term compared to other asset classes like bonds or savings accounts. The key is to do your research, diversify your investments, and invest for the long term to ride out market volatility. That's a brief overview of what stocks are and how they work. In the next section, we'll explore different investment strategies that can help you make the most of your stock investments. We need your support to help our channel grow and reach more people with our engaging content. By subscribing to our channel, you'll stay updated on all our latest videos and help us reach new audiences. So, if you enjoy our content and want to be part of our community, hit that subscribe button and the bell to join us on our journey. Thank you for your support. Together, we can make our channel thrive and create even more amazing content for you to enjoy.